Welcome back, or welcome, depending if it's your first time, to the week that
Welcome to 2025, although we did sneak in last week.
I keep saying that every week, Steve. Yeah. Anyway, I'm back with Steve. Are you well?
Oh, could kill it, mate. Could kill it. Market's expensive. There you go. Thanks, Chris.
See you next time.
Right, I hit that button, mate. John Maynard Keynes.
Well, yes.
Is that what you want to do?
Yeah, well, you've gone there, so I'll follow your suit, mate. Okay. Markets can remain irrational longer than you can remain solvent.
Yep. Okay, it's expensive. Righto, on to Monday. No, but more seriously, what Maynard Keynes was saying there is that, and this is a really important point, is that the stuff goes on longer than you think, right? Mm. You know, you get to a point where you think, oh, man, these people are going to start sobering up soon, and they don't. They keep partying. Right, and that's what Maynard Keynes is saying. What he's saying is, particularly for people like us who look at the CAPE ratio and go, it's at 39, this is it, this is irrational, right? And we're going, oh, it's all going to go to hell. And Maynard Keynes is going, it may go on longer. That's the way it works. So, and also saying longer than you can remain solvent, right? One of the things we're going to talk about in a little separate one is about hedging and options and stuff, right? And value investors often say they suffer from premature accumulation, which is, the thing drops 20% and they start buying because, it's valued at $1.50 and they're getting it at $1.20, right? And then it goes to $1.10 and then it goes to $1, right? And then it goes to 90 cents. So you're sort of looking at it going, oh, man, this is really painful, right? And i.e., you run out of cash and, you want more cash to buy, but you didn't think it would go that low.
Exactly. And we've had a lot of questions about options and hedging over the last few weeks. We'll keep an eye out on specifically Instagram because we're going to launch it on there.
Okay.
Which will just be a special coaching call or masterclass, whatever you want to call it, and you can download it for free. It does curb some of the questions on it. We can't keep up.
Well, it's a really important point because when the market's really expensive, lots of people write to us and say, what do I do? And your general inclination is going, well, what do I buy?
Yeah, I need to buy something.
Rather than saying, well, you can't really easily short the property market.
No.
Right? You can't sort of say, I'm going to buy an anti-house. Right? Well, you can't do that. Whereas in the market, you can say, okay, I can go short.
Yeah.
Right? I can actually bet, instead of all these people betting it's going to go up, I'm going to bet it's going to go down.
Yeah. Well, there's a lot of people that have made a lot of cash, right?
Absolutely.
In equities.
Yeah.
So they're now reaching out to people like us and some other people saying, well, what do I do?
Yeah.
Like, I don't want to keep it in.
Well, the Big Short, if you want a movie to watch The Big Short, which was about the housing bubble in 2007.
Brilliant movie.
Yeah. And it's and a good book too, actually, by what's his name? John Lewis.
John Lewis.
Oh God,
Michael Lewis.
Michael, that's it. Thank you. So that's where you can be creative and say, all right, well, I'll get a bit of gold, get a bit of Bitcoin. I'll do a bit of shorting. There's still some places that are cheap, like we talked about last week. Brazil, yeah. Mexico.
Carry on.
And as you say, just make sure you match it to your time frame, right? Don't buy Brazil and go, it's going to go up in the next 3 months because Steve and Jacob said it's cheap, right? It's like, that's not the way it works, buddy, right? So there's always something to develop. And I think I wrote somewhere, can't remember exactly, but it's about dynamically managing your portfolio, right? Just particularly with hedging, right? You can't just do a short and go, okay, I'll just leave it. You've got to manage it. And, I think I'd said to you, I went short. I was up 15%, then it went up 6%, then it went to 0%, then it was down 2%. And because the market fell on Friday, now I'm up 15% again. So that's really big volatility, right? So you've got to manage that.
Yeah, it's one of the things that frustrates me when I get questions out and about, and do you actually take an interest? When someone asks me, what do I do? My first question is, are you actually interested in managing your own portfolio, or do you just want to make money?
Yeah, yeah.
And the answer is, I just want to know what to buy so I can make some money. You're not the right people for me. I want you to be interested.
Yeah.
Because he can help those. Otherwise, go pay you 1% to a financial advisor.
And that's all right for some people.
Yeah, yeah.
Some people don't, we talked about this with the Enneagram, right? The 9 types. Some people are a bit like, yeah, no thanks. And it's like, okay, well, that's fine. There's no reason why they shouldn't. But, we would argue, well, if you actually did pay attention, you'd probably do a lot better.
Yeah.
And
so
it's
type
your own
7s
money.
and type 3s are general. So you're a 7 and I'm a 3.
7s, 3s and 8s.
And 8s are the other ones.
Yeah.
Which I think
but mainly we've had 7s and 3s.
Yeah.
I can't think I've had an 8 over the years. I've got an 8 wing. Donald Trump is an 8.
Oh, well. That explains a lot, doesn't it?
Yeah, but and funnily enough, it actually does.
So give us a 30-second highlight on a 7.
Well, the sevens.
Yeah.
I'm a 7.
You're a 7,
right? Well, the 7s are basically we want freedom because our main driver is pain. We want to avoid pain, mental pain or physical pain. Right? We don't like pain. We don't like being trapped. Right? Why not? Because being trapped is pain.
So
we don't have any options.
Is that like a 9-to-5 job or something like
that?
that?
Yeah, well, yeah, generally. But what we do is we say we want to be rich because I want to have the freedom to do whatever I want, even if that's doing nothing.
Yep.
Right?
Choice.
Yeah. I'm not going to experience any pain because as soon as something becomes painful, I go, oh, look at that. There's something else new I can do. Right? So in other words, I'm not trapped in this shitty job and it's really painful, right? What we do is go, right, I'm getting another job, right? They call us the Peter Pan of the Enneagram, right? And 3s like you are achievers. America is a sort of type 3 as a nation, right? The French are type 4, right? Arms and legs, bipolar, like outrage and carrying on, right? The French, they're all
emotional.
Yeah, they're all theatrics, right?
Yeah.
Look at the Olympics, the opening of the Olympics, right, with that crazy shit that went on. Everyone went, what? And the French were going, this is great, right? It's like, oh, my God, right? So the French are sort of artistic. The Japanese are, if I remember correctly, the Japanese are like type 6 as a nation, right? But 3s are the big achieving types, right? I've got a set of goals. My daughter's a 3. Set of goals, already she knows she's going to uni, when she's getting married, what she's going to do, all this sort of stuff. And me, I'm like, mate, I don't know what I'm doing next week, right? But my daughter's got her whole life mapped out. But it's not, for her, it's not mapped out. It's achievements.
It's set goals that you need to achieve, yeah.
And so the 3s use money as a reward to say it's a reward for reaching the achievement. I deserve that nice car because that was what I set out to achieve. I set out to save 50 grand for a car. I did it, and now I'm rewarding myself with it.
Yeah.
Right? That's what they're like. Okay. But the subtypes are also, and we should do something about that one day. The subtypes are also really important. Yeah. I won't bore you senseless,
but
it's
important because this Enneagram assessment is actually on our website, and we get a few people every week filling it out. But fill it out. We're happy to reach out to you and give you give a bit of a snapshot. Yeah,
we've got investment maps that help people. The biggest thing I say, Jacob, that where we're different, if I can put it that way, is we talk to people about their own personality. And what I mean by that is not, oh, Jacob, you're 30. Oh, well, you should have a long runway and you should be a high-growth investor, right? That's not the way it works. The way it works is on your personality. You can be 30 but ultra-conservative. You can be 30 and conservative and not give a toss about money. There's a whole raft of things, and that's on your personality, right? And it's really, really important because if you understand yourself, this is the old Eastern philosophy stuff, right? Know thyself, you'll win every battle. Know thyself, know thy enemy, you'll win every battle, right? And even further back, the sages was, know thyself. And the reason why is if you understand why you're doing things, you get the ability to be introspective, to look in the mirror and go, Steve, you're going to do something really dumb. Don't do that dumb thing. Right, because most of us are just on autopilot by our personality. So for me, it's action, right? Even though I've got systematic investing, I'm always going, I could buy a little bit of that. right? It's just ingrained in me all the time, and I have to constantly say to myself, Stephen, stop it. But it's just ingrained because it just looks over. Oh man, that's cheap, and it's got a good PE.
I'll just put a bit in that.
I could just put a little bit in, right?
And just buy one more put option.
Yeah. It's like that, right? Because it's exciting, right? And this is what sevens do. They're bored, right? So we look for excitement. Well, what's more exciting than buying another stock?
Yeah. Right? This is a classic example. Trying to get you to finish that bloody book. And Steve messages me the other day going, Jacob, you got to keep me accountable.
You got to keep me on that book. But it's true. You see, I'm wise enough to know that I've got to say, Jacob, you've got to be pushing me on the book. Otherwise, I'll be going, oh, yeah, I'll do that next week. Yeah. I should finish that chapter. Oh, that's so painful. Yeah, I'll just, And I'm like that on the guitar, right? I play slide guitar for like 3 months and then I get bored with it, right? So I start playing lead guitar and then I start playing lead guitar and then I go bored with it, right? And then so I'm this bloody jack of all trades on the guitar and I can play about 10 songs. But anyway, that's enough of that.
Back to it. So sectoral distribution on Monday.
Yep.
For the S&P 500, obviously, overall it's done very, very well. Energy is something that we've been talking about for a couple of weeks.
Yep.
A couple of weeks now. Is that? I mean, for me, energy, I like for it's got a long runway.
Yeah. For those folks playing at home, essentially what I'm trying to do is the US stock market is really expensive. No argument. But if you drill down. And I'm going to talk more about this in a blog post about diversification. Yep. And the reason why is because I'm not going to bore you with the story now. I'll bore you in a blog post. But it's about you've got to look at the subcategories, right? So, like you said, you've got to look at the distribution and go. It's the old Bill Gates story, right? There's a room full of 10 people and they're billionaires, and one's Bill Gates and the others are all poor, right? Yeah. So it's the same thing. What I'm doing is saying, the US market's expensive, but energy is really cheap. And if you look there, you might go, I'm going to buy, Warren Buffett's continuing to buy Occidental, right? You might look at the big ones like Chevron. Oil service companies. So, that's where you can drill down a little bit. And that's where we sort of say to people, yes, the markets are expensive, but it doesn't mean there's no bargains. What it means is you can say, all right, well, I'm going to buy some energy for the next 5 or 10 years. Yeah, Please don't buy it and think it's going to go up by March.
Yeah, well, it's important you got the right asset allocation.
Yeah, so absolutely.
This is a 5 or 10 year investment, and I'm going to split my 50 grand into A, B, and C.
Yeah.
Cool.
Another beautiful segue into the outrageousness of how global sector fund flows are into technology. I mean, have a look at that. That's like far lap first and the rest of the field finishing afterwards.
Oh, my God.
But it's just, again, highlighting this divergence between the tech sector. It's just overwhelmingly on fire, right? And it's been driven by, the AI stuff.
Yeah, I mean, we've seen a few charts in the past as well where in the next 20 years, the top 7 might not even be there.
Exist,
It could be another top 7. And if that happens, there has to be a change of hands with like stock price.
Yes, absolutely. And sectors, different sectors. Right? Technology always does well in the growth phase, right? Because when you get down the bottom, you want to buy utilities, right? Although this year utilities was the best performing sector, I think better than tech. Utilities was in our bottom 3. Anyway, we'll talk about that later. They fluctuate between winners and losers, right? Which is what we talk about in Well too. And winners don't say winners forever, right? So that's why I say it's always good to look at the losers and go, okay, well, they're probably going to turn around and I should be on them to make more than the average return. I.e., you look at energy, you don't look at technology. If you want to ride tech for the next 12 months, by all means. But I just look at it and go, well, they're very risky. They've made an absolute killing. And, as Maynard Keynes said, they could probably still go on for longer for all I know. But I'm just comfortable going, look, I'm just happy to wait for the reversion in, the sectoral stuff to go on.
Yeah, and that feeds into kind of last week's podcast as well, where we talked about rebalancing, where if there's a big dip, you're spending the next 5 years trying to recover from that.
You always really, I shouldn't say you always, but it's beneficial to look where people think things are hated. Right? So, Brazil, Korea, they're all hated. Oh, God, Brazil, Korea's, they're trying to arrest the former president. Oh, it's a nightmare, but it's really cheap. And you have to say to yourself, well, do you think they'll get over that hump and carry on? Probably. Okay, well, it's really cheap.
Is there any sovereign risk?
Yeah. That's exactly right. Brazil, okay, well, it's like Australia, commodity exporters, commodity prices are low. It's an emerging market. They've got a bit of a socialist government. But the question is, can it get better or, can it get a lot better? Well, yeah. And can it get worse? Yeah, but it's really cheap at the moment. So I think there was a saying, there was a line in a book I always remember, Jeremy Siegel's Stocks for the Long Run, where a guy said, if you think about it, you either have chaos or recovery. And it was just a simple line where I went, that's a banger of a line, right?
I'm going to use that.
Because it's just so classic where you go, yeah, you either have chaos or recovery. And if you think about it from a country perspective, not necessarily a company perspective, because they can have chaos and go broke, but countries generally recover.
Yeah.
Right? They get messy and ugly, but then they generally recover.
Yeah, we've got Russia as an example.
Now, where chaos and you're lost out, right? But that's, those are very rare when you look at all the countries that you can invest in.
Oh, there's going to be a time, and no one knows when, where we might be able to trade in Russia again.
Yeah. I think it'll come. It's just a matter of what shape it looks like. Because I do that myself. I think, oh man, this is awful, and then you think they'll get a settlement somehow, right?
Whether it's now or 5 years.
They'll get a negotiation somewhere. Right, someone's going to lose, or they both get exhausted, or Donald Trump steps in and says to Ukraine, take the deal, or he says to Putin, take the deal. There's a lot of that backroom stuff that goes on, and eventually it gets to the point, even World War, right? They get to the point where they go, man, we're all shit sick of this. Can we just get an agreement? And that's what and then it'll be the next 5 years trying to work out how to put Russia back into the global economy, how to fix Ukraine, what do we do with Palestine, what are the Israelis doing, it's going to be messy for a while, but it eventually settles down into a new rhythm.
It's interesting to think about.
It's pretty turmoil at the moment, I must admit.
It's quite scary. There's
a lot of stuff going on.
There's a lot of big things going on separately as well.
Yeah.
Anyway, back to private debt in Australia.
Next.
It's at historic highs.
Don't trigger me. But just pointing out there that, Australia, look, this is what I mean, Jacob. Last week where, we said the government's debt is 30% to GDP.
Yeah.
People in Australia going, the government debt's outrageous. It's like, dude, your own debt's 180 to GDP and you don't own the currency. Right, that's what I'm saying.
So that's US and Canada up there at 180.
Well, no, US is down below 100.
Oh, I must be colourblind.
See, the US private debt now is really low. You see, because the government debt is really high. So this is the US debt down here.
I see. Yeah,
Here's us in Canada up here. Right? It's that, that's what I mean. You look at that and go, you want to tell me Australia's doing all right. Best of luck.
Thursday.
Mean
reversion, another hot topic.
Yes. I used this slide in the macro valuation session, I think, or market cycles. But
in well too.
Yeah, just pointing out there, when you look at that, if you imagine if I said to you, you come in, you know nothing about investing, right? And I said to you, have a look at that, Jacob. Where do you think you'd buy and where do you think you'd sell? It's pretty obvious, isn't it? Right? This is why we use CAPE and other metrics, right? Now, it's not perfect of using CAPE, right? You wouldn't say to me, oh, Steve, it'd be January the 8th,
No, it's not perfect.
March 9, 2009, I'd have bought shitloads. It's like, no, but what I'm saying is the blue line is the good bit, the red line's the bad bit, right? There's that regression line running through the middle, Okay. So when you look at that, now if you have a look where we are, that's December 24, right? Mm-hmm. So that's a couple of weeks ago. Mm-hmm. Have a look at how far above the trend line it is. Now, here's the next step. You imagine if I said to you, Jacob, it's a great time to buy stocks.
No, I'd say it's not.
You'd be looking at that and going, oh, you might want to run that one by me again, Steve. Right?
Why wouldn't I just buy down here?
Yeah. Why wouldn't I just wait and buy when it's really awful, right? And that's the whole point. That one chart, I could sell anybody on that one chart, right? Because you just look at it and go, why are you talking to me about buying stocks when they're way up there?
Yeah.
Right? And again, it's that Maynard Keynes thing. Could it go higher? Absolutely. But let me get to the main point. It always goes down past that regression line, right? So in other words, it's never going on forever, right? So at some point it turns down.
Yeah.
And that's the highlight, I know it's hard. I know all your friends are rubbing your face in it because they've got NVIDIA or Bitcoin and stuff, but it's just a time to be cautious. Right?
Yeah, and load up throughout those red periods.
Absolutely.
Rebalance into it. Then, because if you actually, this would be an interesting concept, calculating the rate of returns, investing, let's just say monthly, throughout the red periods.
Yes.
And seeing what those were compared to buy and hold.
Yeah. Well, to give you an example, I didn't buy it. I bought Commonwealth Bank in 2000 at $28 or something. And then I bought it again in April 2009, and I bought it for $26.
I think it was, or 28. If you remember the month.
Yeah. Well, mate, when you get a market crash like that, let me tell you remember it, right? But my point being, Commonwealth Bank peaked at about $65 in 2008, I think, somewhere around there. Anyway, as an exercise, I said, I'm going to buy every Friday. I'm going to buy one share of Commonwealth Bank as it fell, right, from the peak of 65. So, 6 by 6, 4, 6, 3, every Friday I bought a share and I got down to 26, I think. Don't hold me to it, but somewhere around there, right? So then it started rising. Now, I started making money, if I remember correctly, again, I think it was you start making money again at about 36, right? Which you sort of go, price. That can't be right. But as I say, if you bought all the way that was falling, it was utterly painful, right? Because you remember, you'd have bought one at 63 when you were buying one at 27, right? You'd have been going, oh, man, this is awful, right? But then when it starts going up, right, and now it's $160.
That's gone gunbusters, hey?
But what you're saying is it's really important. If you're rebalancing downwards, again, that's where you can use the cape and say, well, I'm not going to rebalance at this point. Why? Because the capes drop from 39 to 35, right? Everything's still terribly expensive.
Yeah, or if it's an individual stock, you like PA, like forward.
Yeah. Tesla and Tesla's PE is 180 or something, right? Yeah. Well, the average is 15. So is Tesla a good buy at 150? Well, no. Is it a good buy at 100?
Yeah.
Well, no. But it's fallen 50%. Yeah, but it's still not a good buy. Right, and that's the hard part about the top of the bull market, because when it falls 20%, it seems like it's a long fall. But when you look at it in historical comparison, this chart, you go, man, we've got a long way to go yet, right? So that's the value of taking the historical perspective, because you, as I say, you look at that chart and go, okay, well, that's a no-brainer. You just wait for it to go below the trend line. And then you get in.
Yeah, you're going harder then as well.
Well, you have, as you say, you have a sensible asset allocation policy, right? And you put some in the stock, some in cash, rebalance, right? And over time, you'll do really well.
Very sensible. Unlike the tech sector.
Like the tech sector. Leveraged ETFs, assets under management, AUM, breakdown. So what we're pointing out there is that in terms of leveraged ETFs, 88% of the money has gone into tech leadership.
Wow.
Right. So in other words, everybody is speculating on 3 times NVIDIA, 3 times Tesla, 3 times Mag 7 ETFs. Right. This is why fund managers are assholes.
Well, this is
because they create these ETFs, right? And go, let's get them all in on this, right?
This is an interesting one. There's been a few. I'm not sure who started this conversation, but the next financial crisis is going to be, well, apparently off the back of all these ETFs.
Yep.
And the leveraged ETFs, because they're just full of magic cash and magic money sloshing around.
Yep.
And if they start to margin call and people start to pile out of them, that'll cause the whole thing to collapse.
Absolutely. That's where you get the momentum on the downside, right? You get the margin calls. That's why looking at margin debt's really important, because margin debt is borrowing, right? As we say, you've got to get new money in, right? And if the new money coming in stops, prices fall, right? And it's the same with property. Once they stop lending, it's all over Red Rover. And at some point they have to stop, because you can't go and you can't spend on unproductive debt forever.
Yeah.
Right? You've just got to take a breather. And that's where margin loans are really important, because that's the one thing that you can see that we use to show you and go, look at this, it's starting to fall. And that's when it's really hard, because each step lower triggers a new margin call.
Yeah, well, it just smells like GFC.
Absolutely.
It just smells like GFC, but in equity.
Yep. I just think, look, personally, it might be a long, slow decline, I think. And the reason why is because again, you look at that chart we just had up there before, we're way up past 2007. It's just insane, right?
Huge gap between market price and earnings. This is what we're talking about here.
Yeah.
So,
well, again, just the Maynard Keynes stuff, right?
Yeah. Earnings per share it's earnings steadily grow.
Yeah.
This is what we're talking about.
Generally, earnings are. Robert Schiller said, earnings are generally over the long term. I think it's 4 to 5% or something, right? Mm. But look at the blue line, right?
So this is earnings steadily increasing over time, and this is price.
Now this is only 1 or 2 years, 1 year, sorry,
just a year, yeah.
But again, showing you, the blue line should probably kind of track the white line.
In a perfect world, that's what it'd happen.
Yeah, in a rational world.
In a rational world,
yes, that's right. That's right.
But it doesn't.
There you go. Oh, there's the.
This one?
That's the one. That's the one.
Cheapest
we might go a little bit overtime just to.
That's okay.
Hit the people with this. This is the one we said last week we'd talk about this week, and this is the CAPE ratios that came out in early January, and again you see Turkey's cheap, Brazil, Poland, Hungary, Egypt, China, Korea's at 12, the UK's at 14.5. So there's some cheap markets there. To bastardise Maynard Keynes, they can stay cheaper for longer than you.
Well, that's what I was going to say. The UK has been cheap for a long time.
Yeah. So is Poland. Mm-hmm. Turkey's great. I love Turkey, but man, oh man, it's volatile.
It's crazy.
But it's great fun.
I've never invested in Turkey.
Oh, I have. I love Turkey. It's great. But again, you look at the returns annually of Turkey, and if you rebalance, our Well 2 stuff, you look at it and go, man, like I've calculated, if you hold Turkey, I think it's the last, other than, it went gangbusters in 23, I think it went up 91%. If you held Turkey for the last 15 years, your average annual return was 1%. Right? Mm. But if you do it the way we did it, the annual return over 15 years collectively was 250%, right? And that's because you sold it when it went up 70, right? And then it fell 40, and then you bought it again and it went up 60, right?
Turkey's emerging market, right?
Yeah. But it's all, Turkey is such a strategic player, but it's one of those countries, because it's an emerging market, there's always more volatility there. And it's in a trouble zone, and it's a geopolitical player.
So from 2019, so 11% down 8.6 the year after, down 27 the year after, up 91.
Yeah, there you
after,
go. Yeah,
down 5, up 18, down 0.5.
Yeah, so it's crazy. But when it's really cheap, honestly, if you buy it, you kill it most of the time, right? And again, this is where sensible asset allocation and rebalancing comes in. right? Don't put your whole 10,000 into Turkey at once. Put 5 in, right? And then if it falls down and it's another year, okay, put another couple in, right? And just feed it in gradually, right? So, but yeah, that's the, you've got the Cape and the Cape with dividends, the Cape with cash flow, and the Cape with book value, right? So again, you look at Turkey, it's pretty cheap all around. Brazil's pretty good all around. Poland, I think Poland's going to be a really good one for the next decade.
Right, okay.
Forefront against Russia.
I was thinking that.
They're really kicking some goals in Poland economically. You know, like they're really going well.
I thought the whole Russia thing might.
Yeah. Well, Poland's next, see, in Putin's mind. Russia, Ukraine's first, and then he moves on to some of the smaller ones.
But isn't there sovereign risk there then?
Yes, a little bit, but Poland is now strong enough to withstand Putin, and NATO would, NATO's thinking about, and NATO would step in and all that sort of stuff.
Yeah, okay, interesting.
So anyway, that's the thing, folks. Go and look at the cheap ones. Don't look at the expensive ones.
Where did you find this, Steve? Where is this?
Oh, okay. This is really great. Mebfaber.com. Or Mebfaber has another site called theideafarm.com. Go there.
Meb, M-E-B.
M-E-B, Faber, F-A-B-E-R.com. Or theideafarm.com. You go there, sign up for the quarterly Cape ratios, and he sends them to you for free. Okay. And you get that. Now, that's not all of them. That's only the sort of bottom half.
They're the cheapies.
Right? Yeah, the next page, which I didn't put on there, is all the ugly, expensive ones.
Yeah, okay.
And Australia is about 21. So Australia's a little bit overvalued. So we've got to be a little bit careful, right? And I think part of that, the problem there is the overvaluation of the banks, right?
Yeah, it's like the Mag 7.
Yeah.
The US. If they come down, then everything else is coming down. And talking about the banks.
And that's, again, because, they lend a lot of money to a lot of people who want to buy a house.
Yeah, so if real estate falls, the banks fall.
Absolutely. And the ASX will fall.
ASX falls.
Because they're a big part of the top 10, right?
Yeah, exactly. Cool.
So you've got to be careful.
Lesson of the week. What are you teaching us this week?
Okay, just that one. Remember that other one we took, right? The red line, the blue line, right? This is another one. If I said to you, it's a little bit confusing, this chart, right? Because the figures are at the end of the period.
Right, okay.
Okay, so in other words, 1982, right? You see down the bottom there, 3.97. Now, that's not, that 3.97 minus is what you lost annually if you bought at the peak in 1965.
Right, okay.
So 65 to 82 sucks.
Yeah.
You lose 4% a year.
But if you bought in 82 through to 2000, you made 16 a year.
A year, compound.
Yeah.
Right? That's doubling your money every 5 years, right? About 4.5.
That's what we want.
Right? But again, now at that point, if you buy the Cape 44, you lose 5-6% per year for the next 10 years, right? If you have a 10-year time frame.
Is this adjusted for inflation as well or not?
Yes, with dividends reinvested too, which I don't think's that great, to be quite honest, but, by the by. But see how we're currently tracking at a compound of about 10, and I think it's probably a bit higher than that, to be quite honest. So again, looking at that chart, if I was advising you, why would I say to you, Jacob, just dollar cost average into it? When you're looking at that going, dude, why am I dollar cost averaging in it, when I'm right up here?
Yeah.
Right?
If you came to me in 2010, fine, go for it.
Then I'd be saying, Jacob, you really should be throwing a lot of dice at this because the Cape was at about 13.
Yeah.
We'd had a 50% market crash, right? The world was horrible. Everybody thought we were going to hell in a handbasket. That's the time you want to invest, right? Remember in November 2008, Buffett said, I'm buying America. You should too, right? And he knows a bit about it, right? But he knows because he looks at the yield. He doesn't worry about that squiggly blue line, right?
Yeah, it doesn't matter about the line.
No, he looks at the yield. What am I going to get in terms of dividends and total price return. Right? That's why he's a rich old bugger.
All right. Well, I think that's it, hey?
Yep.
Well, if you have any questions, as always, reach out on the socials. Instagram's probably the best way to get us. We're quite active on that. And keep the questions coming. It's been good the last few weeks. We've been inundated, so it's nice to get some more topics to talk about. Cool. Thanks,
okay.
Steve.
Cheers, folks.
See ya.
As always, remember, we don't provide financial advice.